Welcome to Talk Tickers. We're the show that digs into earnings calls to pull out the key insights for you.
Saving you time, keeping you ahead.
Exactly. And today we're getting into the Marriott International first quarter 2025 call. The headline, pretty strong start to the year.
Yeah, definitely. They actually beat their own expectations, which is interesting given, all the talk about macro uncertainty.
Right. So what were the key numbers?
Well, global RevPAR, that's revenue per available room, was up 4.1%.
And their guidance was, what, 3 to 4%?
Precisely. So they cleared the high end of that range. That came from ADR, average daily rate, being up 3%, and occupancy ticking up 1 percentage point globally.
Okay, solid performance metrics. Yeah. And they're growing the hotel base too.
Oh, absolutely. Development was really active. They hit a record for first quarter global signings.
Wow.
Yeah. And net rooms grew 4.6% over the last 12 months. So definite expansion happening.
There's always a but, isn't there? They did adjust the full year outlook slightly.
They did. Just a minor tweak downwards for the full year RevPAR growth by about 50 basis points.
And that's mainly because of the US and Canada.
That's right. A slightly more, let's say, cautious view on how the US and Canada will perform for the rest of the year.
Okay, let's unpack that Q1 performance then, region by region. How did the US and Canada actually do in Q1?
So US and Canada RevPAR grew just over 3%. What was interesting, though, was the split.
How so?
Luxury and full-service hotels did significantly better than the select service ones.
Oh, okay. Driven by?
Strong group demand, think conferences and events, and also solid transient demand individual travelers. But they did note that growth softened a bit in March.
Particularly in select service, you said.
Exactly. That's where the March slowdown was most noticeable in the US and Canada.
Got it. How did that compare internationally?
International was quite a bit stronger overall. RevPAR up nearly 6%.
And where was that strength coming from?
Asia Pacific was the real engine, up 11%.
11%. That's huge.
It really is. And within APAC, India and Japan were standout performers. RevPAR up 16% in India, 17% in Japan. Just shows massive recovery and demand there.
Incredible. What about the other international spots? CALA and EMEA?
Yeah, good results there too. CALA Caribbean and Latin America saw RevPAR rise 7%, mostly driven by luxury properties and resorts.
Okay.
And EMEA, Europe, Middle East, and Africa was up 6%. That was a mix of solid ADR and occupancy growth, particularly strong transient demand there.
Now, China is always a bit of a different story. How did Greater China perform?
Greater China actually saw RevPAR dip by 2%.
Oh, okay. Why was that?
Partly the weaker macro environment there, and also they were up against tough comparisons from the previous year. But interestingly, they still beat their own expectations for China.
Wow.
Strong domestic demand within China helped offset some of the other pressures.
Right. Okay. So if we slice the data by customer type instead of region, who was driving the growth?
Group business was definitely a highlight. Global group RevPAR and U.S. group RevPAR both up 8%.
8% for group. That's really strong. Suggests meetings and events are properly back.
It certainly looks that way.
What about individual travelers? Business and leisure?
Both business transient and leisure transient were up 2% globally. In the U.S. specifically, it was a bit softer, up 1% for both.
And that growth was mainly rate-driven?
Primarily ADR increases, yes.
Okay, let's circle back to that lowered full-year guidance for the U.S. and Canada. What exactly are they worried about?
Well, they specifically called out an expected continued decline in demand from the U.S. government.
Okay, that makes sense. Anything else?
And also, yeah, that slightly slower growth expected from the U.S. select service hotels. They're seeing maybe lower transient demand and marginally less group business for that specific segment.
So it sounds like that international strength is going to be pretty crucial for them this year to balance out the U.S. softness.
Absolutely. They explicitly said they expect international RevPAR growth to be meaningfully stronger than in the U.S. and Canada going forward.
And looking at the customer mix for the full year, how do they see that playing out?
They're still betting on group to have the strongest RevPAR growth overall for 2025.
Okay.
Followed by business transient, and then leisure transient growth is expected to be the most modest of the three.
Right. Let's switch over to development. You mentioned record signings. Tell us more about that pipeline.
Yeah, it's impressive. Those Q1 global signings were up 35% year over year. Huge jump.
35%.
And the total pipeline is now over 587,000 rooms. That's a record number for them. And importantly, 42% of those rooms are already under construction.
So a lot of that growth is actually, physically happening now.
Exactly. It signals real momentum for future openings.
What's driving it? Is it all new builds?
Not entirely. Conversions are a really big piece of the puzzle.
Meaning hotels switching to a Marriott brand.
Correct. About a third of the signings and a third of the openings in Q1 were conversions. It's a stable and significant growth driver for them globally.
Any specific brand moves?
They sound really enthusiastic about the citizenM partnership. They expect that to really boost growth in that sort of lifestyle select service space.
And when does that deal close?
Expected in the back half of this year. It'll add over 8,500 operating rooms straight away, plus about 600 pipeline rooms.
Okay. And loyalty. Marriott Bonvoy is huge. How's that doing?
Still growing. Nearly 237 million members by the end of March.
Wow.
And member penetration hit a record 68% of all room nights globally were booked by Bonvoy members.
68%. That's incredible loyalty leverage.
It really shows how powerful that program is for them.
Okay, let's talk hard financials from Q1. Beyond RevPAR, what did the P&L look like?
Total gross fees were up 5% year over year, hitting $1.28 billion.
Okay.
Incentive management fees, though the fees based on hotel profitability actually dipped slightly, down 2% to $204 million.
Why the dip there?
Well, increases in Asia Pacific were more than offset by declines in Greater China and also EMEA for those specific fees.
Gotcha. And costs. How do they manage expenses?
G&A, their general and administrative costs, were down 6% year over year. They said that was primarily due to lower compensation costs.
Okay, so that helped the bottom line.
It did. Adjusted EBITDA came in at $1.22 billion for the quarter. That's up 7% from last year.
Pretty healthy profit growth then. And what's the outlook for the full year on profitability and returns?
They're projecting a full-year adjusted EBITDA growth between 6% and 9%.
Okay.
Adjusted diluted EPS, earnings per share, is forecast between $9.82 and $10.19.
And shareholder returns?
They're planning to return around $4 billion to shareholders for the full year. Buybacks, dividends, that sort of thing.
Okay, so quite a bit of info there. If you had to boil it down, what are the sort of key themes or takeaways investors should be focused on right now from this call?
I think there are a few big ones. First, the macroeconomic uncertainty is real, especially impacting the U.S. outlook.
Right, the cautiousness.
Second, that specific headwind from lower U.S. government demand seems persistent. Third, the resilience at the higher-end luxury hotels are performing well. No major signs of people trading down.
That's interesting.
Fourth, the development pipeline remains super strong, suggesting long-term confidence, maybe helped by low supply growth in North America historically. Fifth, conversions are a key, steady growth engine.
Okay.
Sixth, international inbound travel to the U.S. is recovering well, which is a positive, even if Canadian inbound was down a bit in Q1.
Yeah.
Seventh, group bookings look solid well into the future, even into 2026. And finally, their digital transformation push is ongoing.
Okay, that's a good summary. From an investor perspective, then, what's the crux of it?
Well, you've got that slight downward guidance revision for the U.S., reflecting the near-term caution and that government piece. But you contract that with the incredibly strong development pipeline showing long-term optimism.
Right, that tension.
Exactly. And then there's the strength of international, especially APAC, acting as a growth driver. Plus, the resilience of luxury demand and the strategic move with citizenM expanding their reach. It's a mixed picture near term, but with strong underlying long-term drivers.
Okay, makes sense. Right then, let's pivot to our "This is not financial advice" segment. Purely hypothetical, maybe a little bit out there, trade idea based on this call.
Right, disclaimer firmly in place. Given what we've heard, the real strength and positive outlook for Asia Pacific, contrasting with the more cautious tone around U.S. select service hotels due to government demand and maybe some macro softness, an outrageous but plausible idea could be a pairs trade. You'd go long hotel REITs or maybe operators that have significant exposure to that booming Asia Pacific market. You're betting on that continued recovery and pent-up demand.
Okay, long APAC exposure.
Yeah, the other side of the pair.
You'd hedge it potentially by taking a short position in REITs or operators that are heavily weighted towards the U.S. select service segment. The thinking is that continued U.S. uncertainty plus that government headwind might put more pressure specifically on those types of properties.
So capitalizing on the diverging regional and segment trends. Exactly. It's a bet on APAC outperforming U.S. select service in the near to medium term. But again, purely hypothetical, for discussion only, definitely not financial advice.
Absolutely noted. Okay, that wraps up our deep dive into the Marriott International Q1 2025 earnings call.
We've hit the key results, the regional variations, customer segments, the guidance shift, and that longer-term development story.
And hopefully that breakdown gives you a clearer picture of where Marriott stands and what might be ahead. As always, this isn't investment advice.
Just trying to connect the dots from the call.
So what stood out most to you from Marriott's quarter? What do you think are the biggest hurdles or opportunities for them going forward? We'd love for you to continue the conversation.
Let us know your thoughts. Thanks for tuning in.